Hello, happy Friday focus. So it is Friday, the 25th of March. I'm not actually here. I'm recording this because I'm hopefully in Portugal. If I'm not recording this, then I'm not in Portugal. So I hope you've had a really good week and that you've got a lovely weekend planned with any luck. So what are we talking about today? We're talking about what KPI small business owners should be tracking. As a small business owner, you've got the power to decide what your priorities are. However, regardless of your goals for the company, there are certain KPIs that really need to be tracked in order to ensure success. There are 5 KPIs that will help you give you an idea of how well your company is doing financially and if it's on track to meet its goals. So what are KPIs? KPIs are key performance indicators. It's a way for companies to measure the health of their business by evaluating certain factors such as increased sales or decreasing spending, things like that. You cannot track every single possible KPI under the sun. It's impossible. However, there are some universal KPIs that you need to keep an eye on regardless of your niche and your business model. So the first most important one is net profit. Net profit is the amount of money that your business makes after factoring out of all of your expenses and other costs. So when you look at your figures, you'll look at your sales or your turnover or your revenue, whatever you like to call it. You will take away all of your expenses, so your cost of sales, i.e. your variable costs, and your fixed expenses. And whatever you are left with, that is your net profit. That is the most important KPI or metric, depending on who you are and how you work. But that is the most important one. It's really important to understand the difference between revenue and profit. Let's say that your business turned over 100,000 last year. If you spent 40,000, then your net profit is going to be 60,000. Okay. However, if you turned over, say, 120,000, but you spent 80,000, you still keep 40,000 as profit. Now, that is according to the generally acceptable accounting principles, which is the normal formula for running a business: sales minus expenses equals profit. And you look at your sales, you take away your expenses, and whatever's left is your profit. That is what we as accountants have to do your accounts, to work out what your net profit is. Do not get confused with profit first, where the formula flips itself to sales minus profit equals expenses, i.e. whatever's left over after you take out the profit is left to pay your expenses. But as far as we're concerned, as far as the KPIs are concerned, which is the accounting ones, not the profit first ones, it's really important to understand what net profit actually means. So your net profit margin is the second one. This is the percentage of net profit that your company makes. This number represents how efficient or not that you are with your finances and whether or not you are making a healthy amount on every single sale, preferably. If this figure drops, it could be an indicator that there is an issue in terms of spending or that revenue increases need to be made. So let's get back to the example above. Again, let's say that you made £100,000 in revenue and you spent £40,000. Your net profit is £60,000. That would give you a profit margin of 60%. Now, let's imagine that you made £120,000 and you spent £60,000. Your net profit is still £60,000, but your profit margin has decreased to 50%. Now, you need to know how to work out this, unless you have a cloud accounting system, in which case it'll work it all out for you. But your net profit margin is worked on your net profit, i.e. in this particular case, it was £60,000, divided by your revenue. And that will tell you what your net profit margin is. So when somebody asks you what your net profit is, in that particular case, you'd say that your net profit was 60,000. But you'd say your net profit margin was 50%. Now, it sounds weird to have to, it sounds practically the same, but it's not. So it's really important to understand the difference between the two. Quick ratio. Quick ratio is a number that represents how efficient your company's liquidity is. So it tells you whether or not your business can meet its short-term financial obligations with the assets it currently has on hand. So in this sense, quick refers to liquid, i.e. money in your bank account or that's easily convertible from selling an item or something like that, or selling stock, whatever. Quick ratio is calculated is like this, okay? So you've got your cash plus your marketable securities. So your marketable securities is anything that is easily converted to cash, plus your accounts receivable, i.e. what is owed to you, divided by your current liabilities, and that gives you your quick ratio. So your current liabilities are what you owe. So that's your cash plus whatever securities that you have, investments that you have that can be easily got rid of or sold, plus the money that is owed to you, so your debtors, divided by your current liabilities, i.e. what you owe. And that will give you your quick ratio. If your quick ratio is 1 or higher, then it's good news for your business, because it means that you've got enough assets to cover your expenses and keep your company afloat. A number lower than 1 suggests that your business is struggling a bit and, struggling to meet its obligations, should we say, and may need to borrow money or liquidate some assets quite quickly. So the next ratio, or KPI, that we need to keep an eye on is the cash to debt ratio. The cash to debt ratio tells us how much liquidity a company has relative to its liabilities. So it's another really good indicator of whether or not your business can pay off any debts it might have. To calculate your cash to debt ratio, divide the company's cash by its current liabilities. Simple. So it's your cash from whatever you've got in the bank divided by the total amount of money that you owe. End of. This is how long it would take for your business to pay off its current liabilities if it used all of the cash in hand. You should use your cash to debt ratio to help you figure out how much your short-term and long-term debt your business can actually handle as well. Cost of customer acquisition. As a small business owner, attracting new customers is no doubt probably one of your primary goals. But how much do you need to spend in order to be able to do so? Do you know how much it costs you to get one customer? The cost of customer, I can't even say it. Cost of customer acquisition is the amount you spend on average to get a new customer. You should use this metric to inform your sales process and marketing strategies, because it can give you an idea of how much money you need in order to compensate for all of those costs associated with bringing the customers on board. So the KPIs that small business owners should be tracking to ensure financial success are net profit margin, quick ratio, and the cash to debt ratio. Oh, and the cost of customer acquisition as well. These numbers can really help you make more informed decisions about your business and to ensure it's financially stable. This is what I help my clients do, because they need to understand these figures. It's all very well saying, well, you need to know your net profit margin, you need to know your cost of customer acquisition, your cash to debt ratio. But they're like, how? Why? What do I need to know these? What's it going to tell me? And helping my clients work out what those figures are for a start, so that they can work them out for themselves when they need to, but also what they're useful for. And that is the thing. It's all very well understanding what those numbers are and looking at a profit and loss or your accounts and saying, yeah, okay, fine, I understand it. Do you know what to do with those figures? Because if you don't know what to do with those figures, then you don't actually understand it. And it is really, really useful to be able to understand it. If you need more help with this, you want to understand more about KPIs and benchmarking, etc., things like that, please do let me know. And I'll be here to help. Thank you. Bye.